Good afternoon. My name is Allison Baker, and I want to welcome you to Venable's Regulatory Enforcement Actions and Advertising Practices 2020 Update webinar. This afternoon, I am really lucky to be joined by a great panelist of experts, starting with my partner, Jerry Sachs. Jerry, immediately before joining private practice, was an enforcement attorney, one of the founding enforcement attorneys at the CFPB. Before that, he worked at the Federal Trade Commission, where he handled a host of advertising-related practice cases, including those in the financial services space. And before that, he was an assistant U.S. attorney in the Northern District of Georgia, where he worked prosecuting cases under Sally Yates. I'm also grateful to be joined by my colleague, Erin Cass. Erin is an associate in our consumer financial services and litigation practices. Erin almost entirely and exclusively handles pretty much every consumer financial services enforcement investigation that Venable takes on. She has extensive experience handling cases in the CFPB, FTC, and state attorneys general context. I'm also grateful to be joined by my colleague, Tiffany Williams. Tiffany is an associate in our consumer financial services and litigation practice at Venable, and Tiffany has extensive experience handling civil and criminal enforcement cases, as well as those that result in litigation. And today we are going to be discussing what we're seeing in terms of trends in the consumer financial services space, especially those relating to advertising. I want to note that later on in this broadcast, we will be announcing the CLE code. This is eligible for CLE credit in a number of different states, and we will be announcing that code about 2/3 of the way through the presentation. Today, we're going to be talking about recent CFPB enforcement actions that focus around allegations of misrepresentations, recent Federal Trade Commission enforcement actions and litigation cases also dealing with alleged misrepresentations in the financial services space. We're going to focus a bit on how these agencies are also responding to allegations and misrepresentations in light of the COVID-19 pandemic and what impact that pandemic is having and we expect will have on enforcement priorities of these agencies. And of course, as always, we're going to be giving you some thoughts on how you can best prepare yourselves for these, what we expect to be future actions that these agencies will be taking and how you can best navigate 2020. So first, I want to talk a bit about what we're seeing in our space. Notwithstanding the current pandemic, the Consumer Financial Protection Bureau and the Federal Trade Commission are very active agencies. In fact, I would argue that they have become even more active as the pandemic has gone forward, in part because their mission involves protecting consumers. And of course, consumers are especially vulnerable at this moment, especially in the financial services space where consumer credit has become a somewhat precarious situation. We're continuing to see the CFPB move cases forward in litigation and investigations. The Bureau is both continuing to examine entities that are within the scope of its examination authority, although it's doing so in a way that makes accommodations for social distancing. We're also seeing the Bureau initiate new investigations. Similarly, the Federal Trade Commission is continuing to move investigations forward and has made it very clear that it's taking very seriously the its enforcement authority, particularly in light of the pandemic. In addition, we're continuing to see a host of prudential banking regulators, including the OCC, the Office of the Comptroller of Currency, the FDIC, the Federal Reserve Board, the National Credit Union Association, move forward with their examinations, investigations, and to the extent needed, litigation. We're going to talk a bit about that later. And we believe very strongly that, number one, to the extent your best practices have been in place since before the pandemic, if anything, you should continue with those best practices, obviously adjusting for the social distancing and remote working realities. And you should continue to be particularly mindful of all consumer-facing practices that you engage with. Now, I want to turn our slide over to my partner, Jerry, who's going to walk us through some recent CFPB enforcement actions.
Thank you so much, Allison. I am actually going to pass this over to Erin, who's going to talk about this matter.
Hi, thanks so much. This is Erin. This first case that we're talking about here, the Cottonwood Financial case, also called Cash Store, involves a financial services company that's based in Texas. It operates in locations in about 7 states across the country And they make short-term small dollar loans, including payday loans, installment loans, and auto title loans. But the part of the Bureau's focus in this case was that Cash Store had put out certain television advertisements claiming that consumers could save 50% on finance charges. And in reality, it turned out that the consumers would pay the first full finance charge in full. They later were mailed a 50% rebate on the first charge, but still had to pay 100% of the remaining finance charges. And so the Bureau looked at the TV advertisements, which had a screen that would say, save 50% with a fine print text disclosure at the bottom saying that the discount was available only as a rebate and only for the first finance charge. But the other parts of the ad would include voiceovers that said, call now and save up to 50%, and didn't note any limitations on the discount. And similarly, there was a telemarketing campaign where telemarketers would describe the discount as a 50% discount, but didn't disclose the limitations and didn't direct consumers to go to the website where they might have seen those disclosures. The Bureau has alleged, and it's part of the consent order, that the representations were likely to mislead consumers acting reasonably, and that these statements were deceptive acts or practices and violated the CFPA. So that the result of the consent order is that the company agreed to pay about $286,000 in restitution and $1.1 million in civil money penalties, as well as some injunctive relief as well. And I think the next case we're going to talk about is the Upstate Law Group. In this case, is a little bit different. This was a joint lawsuit that was filed in federal district court in the District of South Carolina by the CFPB, the South Carolina Department of Consumer Affairs, and the Arkansas AG. And this complaint, it was just filed at the beginning of the month. It alleges that the Upstate Law Group worked with companies, these brokers, which the Bureau last year settled a case against the brokers. This new case focuses on the law firm under a substantial assistance theory. And essentially what the complaint alleges is that the brokers, with the law firm's help, arranged for contracts between consumers and investors. And these consumers were often disabled veterans. And the consumers would get a lump sum payment, and in return for that, they would agree to pay back the investors with a much larger amount, assigning part of their monthly pension or disability payments. And the products were marketed as sales of payment. So, for example, the information packets that were sent to consumers said, this is not a loan, you are selling a product for a set price. And what the complaint alleges is that the transactions were not actually sales, they were actually offers of credit, and that the law firm substantially assisted the brokers in these violations by assessing the consumer's creditworthiness, conducting the underwriting, approving and denying the contracts, and serving as a payment processor. So as a result of that, the Bureau has alleged that they have violated the CFPA and are seeking injunctive relief as well as restitution and civil money penalties. And I think now I'm going to turn it over back to Jerry to talk about some of the other CFPB actions we've seen recently.
Thank you, Erin. And I want to take just a moment to let everyone know that we appreciate your patience with us on this call. It's a difficult time to be doing a webinar, but in case you hear any of our kids in the background doing Zoom classes or FaceTime playdates or dogs barking or whatever it is, we appreciate your patience. We are, as everyone knows, everyone is working from home or wherever they can at this point. And part of what we're seeing with regulators in this during the COVID-19 crisis is that some cases obviously started before the crisis, and some are ongoing and being settled right now during the crisis, and others are being started. We continue to see CIDs. We continue to get outreach from the CFPB and other regulators asking questions about either new cases or cases that have been ongoing or moving litigation forward. One thing that I do like to note about the CFPB is before the current CFPB administration came into office, there was a lot of talk of it's just going to be a standstill and nothing's going to happen. We have not seen that prediction come to fruition. And what we have seen is the Bureau move forward with more selective enforcement actions and focus on certain industries or certain areas. And as you can see from some of the CFPB cases, notwithstanding the rollback of the small dollar lending rule, there are a lot of actions that are going forward and being settled, at least in the first quarter of 2020, that relate to small dollar lending and advertising as it relates to financial services. In particular, the CFPB does have or did have a focus that has not entirely stopped, focus on tribal lending. And that brings us to Think Finance and the various entities that were associated with tribal lending. To the extent anyone is associated with tribal lending, it does come with slightly higher risk. It is not necessarily unmanageable, but it's something that you should be aware of. The Bureau has taken particular interest in whether tribal lending or lending from foreign countries violates state law, and they've taken a position that to the extent it's over a usury interest cap, that makes the loan either void or voidable. And that is what the tribal lending suit against Think Finance was about. One area that the Bureau also focused on was the debiting of bank accounts, a Regulation E issue, for lack of a better way to put it, or just a UDAP, which was taking money from accounts where you did not have a right to, or double debiting accounts and not correcting that. The Bureau's position on double debits seems to be, notwithstanding the correction of that, that could still cause a law violation. So just something to be concerned about and think about. And one point that I do like to raise about these tribal lending cases is, to the extent the current administration keeps going on these types of cases, or a new administration amps it up a little bit, there could be a concern as it relates to payments or money transmission in violation of state law, that you could see the CFPB potentially making that a federal UDAP as well, which could raise a whole host of issues, especially if things are done inadvertently. So the Think Finance companies settled with the CFPB, and of course, I can't tell if it was lucky for them or bad for them that they were in bankruptcy, because the settlement entailed a dollar civil money penalty, which means effectively any harmed or allegedly harmed consumer can get 100% of their money back. And then, of course, the bankruptcy state will have funds available depending on the size of the creditors pool in bankruptcy. I have not seen the CFPB pushing its civil money penalty fund out to consumers to ensure that redress is, as high as possible, but it does help consumers make redress available. One thing that I am unclear on, and I'm not sure that defendants are necessarily doing this, but it's something that we would, for example, recommend or suggest that defendants consider, would be tracking civil money penalty payouts to impacted victims to the extent there is a parallel restitution or disgorgement type order. And of course, any order from the CFPB or the FTC, generally the states as well, comes with a monetary provision, and then coupled, that is always coupled with injunctive relief of some type. The next case that we're going to look at is the Monster Loans case. And the Monster Loan LendTech case is a student loan debt relief case. This is another area that the CFPB has been focused on. This is one case in the first quarter of 2020, early 2020. The CFPB has filed other ones, and this is sort of an area, student loan debt relief, that, in my opinion, brings an extraordinarily amount of risk. But notwithstanding the fact that there may be a small niche of businesses involved in this area, one of the overarching principles is be careful about what you say and make sure you're in compliance with all of the laws that relate to your product or service. In this case, the companies were obtaining information through a nationwide credit reporting agency under the guise of offering mortgage loans, when what they were actually doing was funneling the information to a student loan debt relief company that was then allegedly making numerous misrepresentations, including interest rate reduction and credit score improvement. And this case is ongoing in the Central District of California, which, for lack of a better way to put it, seems to be an epicenter of student loan debt relief companies. And now I'm going to hand it back over to Aaron and Tiffany to talk about some recent FTC enforcement actions. But before I do that, I do want to mention one other thing about the CFPB that we are seeing, and that is coordination with states' attorneys general offices across the country. So again, while the CFPB may have slowed down in certain types of enforcement activity, it is cooperating across the board when that comes to coordinating with states' attorney generals on issues that are important to the Bureau. As it relates to the COVID-19 crisis, and we'll talk about this later, one thing that should raise concern for everyone on this call is, to the extent you change any of your business practices, you should revisit your terms and conditions to make sure those match up. We have seen, at least in our practices on numerous occasions, that the CFPB note that the terms and conditions either left something open that you could do, or were allowing you to do something in opposite of what a business is actually doing in practice. And that can raise some leverage, or at least a point for the CFPB to try to push forward on some type of claim. And with that, and again, appreciate everyone listening in and participating today. I will turn it back over to Erin and Tiffany.
Thanks, Jerry. So this first FTC enforcement action that we're going to talk about, I think relates to some of the points we'll talk about later about the impact of COVID-19 and on some of these agencies. This first case is just from just about a week ago. A complaint was filed by the FTC against these defendants who are doing business as a company called SBA Loan Program, and they are, according to the FTC, falsely claiming to be an approved lender for the CARES Act Paycheck Protection Program loans. What the complaint alleges is that the defendants are calling small businesses in order to solicit applications for the PPP loan programs. They claim to be calling from the SBA, and that they have also claimed that they're actually already working with the consumers' banks. And their websites say we are a direct lender for the PPP loan, and they direct consumers to an online loan application that appears to be for the CARES program, the PPP program. And in reality, the FTC alleges that these defendants are not authorized SBA lenders, they're not authorized to process PPP loans, and they're not affiliated with the SBA or the U.S. government. I understand that the SBA actually sent them a cease and desist letter about a week before the lawsuit was filed, and apparently they were continuing with their representations, and so the FTC has filed this lawsuit alleging that these are a violation of the FTCA's prohibition on unfair, deceptive acts or practices. So I think this litigation is ongoing in the district court in Rhode Island, and I think we'll talk a little bit more later about some of the other actions that we're seeing focused on some of these recent effects of the COVID-19 emergency. And I'm going to pass it over to Tiffany to talk about the next case.
And real quick,
Thanks,
before
Erin.
you start, Tiffany, I just wanted to add that this is a perfect example of notwithstanding a pandemic, the FTC is not sitting on its hands, and it is taking action when necessary, especially as it relates to the CARES Act and the small business and lending. So to the extent anyone listening is involved with that program or getting funds from it, there are certain considerations that you want to take into account in how you advertise or use those funds. And so I just wanted to raise that now. And Tiffany, turning it back to you.
Sure. Thanks, Jerry and Erin. And to Jerry's point, at several points later in this presentation, we'll provide tips and recommendations that we have for what the audience is considering in terms of, kind of getting involved with online merchants and different activities and products during the COVID-19 crisis. There are definitely steps that need to be taken, and fortunately, our firm has a very robust task force that can assist with a lot of those needs. But that's just a sneak preview. Onwards to Slack Incorporated. So contrary to our PowerPoint, this did not happen in the future. So this was March of this year, though I'm certain these types of activities will probably still be a problem in 3030. But essentially what kind of happened in this case is that allegedly in this scheme, the defendants conducted telemarketing calls and would falsely claim that they could substantially reduce consumers' monthly payments on their federal loan debt by enrolling them in income-driven repayment programs. And I'm certain everyone in finance is familiar with how income-driven repayment programs work. But generally speaking, there's a list of criteria that can ultimately lower an individual's monthly payment. And that includes income, obviously, and then family size. What tended to happen in this situation was that defendants would either misrepresent to consumers or potential customers how to report their family size to be more inclusive. Higher the family size, the more likely that your monthly payment would go down. Or they would submit the borrower's or the consumer's student loan modification or consolidation application and lie about the borrower's family size, oftentimes without that borrower's knowledge. And so kind of interestingly and kind of part of the list of, alleged wrongdoing that defendants in this case got involved in was that once a consumer agreed to purchase the defendant's services, the defendants collected fees up front. And this is going to be a very common theme with a lot of cases that I know I will personally be discussing, but will be a common theme throughout this presentation, which is upfront fees are bad. And so in a lot of these defendants that entered in settlements, usually charge some type of fairly obscene upfront fee, but an upfront fee nonetheless. And in this situation, the initial fee was commonly close to $700. And then subsequently, there would be one or more monthly fees closer to about $40. And all of this would occur, or the consumer would pay before their loan was modified, or before the consumer made a payment according to the newly modified loan. And defendants would also, kind of a second part of the alleged wrongdoing, defendants would also offer consumers who contracted with them a check or a gift card for $20 to write positive reviews about their services on the Better Business Bureau's website. And all these activities essentially violate Section 5A of the FTC Act for unfair, deceptive acts and practices. Ultimately, the outcome, again, in March of 2020, defendants agreed to a stipulated settlement, which is essentially entailed defendants would be banned from providing debt relief services, but they were allowed to continue assisting existing customers to complete their loan modification or consolidation forms for the Department of Education, but with the caveat that this would only apply for customers that expressly chose to still use their services. And then defendants were also required to turn over about $470,000 in assets, after which time the remainder of it was a total of about a $23.9 million suspended judgment due to defendants' inability to pay. And again, kind of a little interesting nugget to this case is that the judge in this action has postponed the action for 60 days for now because of the COVID-19 crisis. So again, common theme is that a lot of these agencies, FTC, CFPB, other regulatory agencies are still actively pursuing enforcement actions, litigation, but, every so often, maybe in certain situations, the litigation might be stayed or the parties might stipulate to the case being stayed for a certain period of time, depending on the difficulties associated with the COVID-19 crisis.
Thanks, Tiffany. This is Allison. So I wanted to talk some more about additional, some more recent FTC enforcement actions, too, in particular, Boost My Score and Lend EDU. So Boost My Score was a settlement that the Federal Trade Commission had. With Boost My Score in March, so March 9th of this year, so right before the pandemic really took effect and there were shelter-in-place orders, although I don't actually think that fact would have changed the FTC's position in this matter. So basically, Boost My Score was alleged to be engaged in what's called credit piggybacking, basically targeting consumers and saying to them, and in this case, it seemed to be largely consumers who were seeking mortgages, and saying to those consumers, you can piggyback off of some other consumers' better credit score in hopes of you basically getting the benefit of their credit history, and we'll charge you a fee for this. Suffice to say that's not allowed, and the Federal Trade Commission sought and actually received $6.6 million in equitable relief, so basically restitution back to consumers, and another $64,863 in civil money penalties. This is an interesting case because I think what it speaks to is instances where you have what the Federal Trade Commission and also the CFPB might call vulnerable consumer segments, people who need credit, people who maybe don't have great credit and are trying to do something like either buy a house or refinance a mortgage, and basically are looking for an opportunity to do that. And lo and behold, Boost My Score is a business that was alleged to basically be engaging in a false promise that we could link your score up with someone else's credit history, and you in turn, consumer X, would get the benefit of that and qualify for a better term or condition on a mortgage or a refinanced mortgage. The Federal Trade Commission found that this violated its prohibitions against unfair and deceptive acts or practices. It's Section 5 UDAP with 1A. The CFPB has UDAP with 2 A's because it also has abusive. It found that the company allegedly engaged in behavior that violated the telemarketing sales rules, prohibition against taking advance fees, and I'll talk about that in a minute. It violated the Credit Repair Organizations Act, which essentially says that you can't hold yourself out as a company that can repair or help people's credit. And if you do, you better have the credentials to back up your claim, or else you're misleading consumers by making them false promises around what you can do to help their credit. And essentially, the Federal Trade Commission essentially found that this was, pretty outrageous behavior. And if you read the quote in its press release from Andrew Smith, who runs the Bureau of Consumer Protection, it's a pretty stridently worded quote. Andrew's a usually pretty moderate person. So I think that, it spoke to certain concerns that the FTC has now and is likely to have in the future as consumer credit becomes harder to secure, and as you have many consumers whose credit histories are perhaps less than stellar as a result of losing their jobs or losing substantial sources of income during this pandemic. So obviously it's mission critical that anyone who engages in behavior that's consumer facing needs to make sure that the description of the service they're offering is correct and accurate and actually matches what the consumer's getting. And to the extent you're offering a product or service, you need to make sure that you can actually legally offer that product and service. In this case, the allegation was that Boost My Score did neither. So the telemarketing sales rule, just very quickly, essentially prohibits companies in the credit repair space from taking fees from consumers before those consumers have received the benefit of the alleged credit repair activities, namely an improvement in their credit score. And it's a provision of the telemarketing sales rule that the Federal Trade Commission and the CFPB use with frequency. And it's really designed to stave off, false advertising claims, because it basically says, look, put your money where your mouth is. We'll pay you once you've done what you say you're going to do. And the only way we can prove that, you've actually fixed my credit, for example, if I'm a consumer, is by looking at my credit score and looking at my trade lines and my credit report and seeing some market improvement. And until those improvements are made, fees can't get collected. So this is a really important provision that the Federal Trade Commission and the CFPB enforce in the telemarketing sales rule. The other case I want to discuss really briefly is the LendEDU case. And LendEDU was a Federal Trade Commission settlement back in early February of this year. And in a nutshell, LendEDU involved allegations that the business was basically hosting a website that purported to give consumers a line of sight into what might be the best lending options for those consumers. But what LendEDU allegedly neglected to do was to tell consumers that it was getting compensation from the companies whose loans it was advertising or describing to consumers, and that compensation in turn informed LendEDU's decision to tout a particular lender, service, or product. And the FTC found that this violated its prohibitions against unfair or deceptive acts or practices, Section 5 of the FTC Act. And again, arrived at a settlement that the company would pay $350,000 and injunctive relief as well. And again, the reason this is important is because and just kind of putting it into the context of what's happening right now, there are going to be a lot of companies out there that are touting or purporting to tout opportunities for consumer credit, hopefully most of those companies will be legitimately doing that. They will disclose any compensation that they receive in exchange for those postings on their website. But it's important to understand that as consumer credit becomes harder to come by, and as we see an unfortunate consumer credit crunch, which we expect to see in the next quarter as well as in this quarter, a lot of this activity there's going to be an uptick in a lot of these allegations and alleged activity as well as actual activity, and this is going to put the Federal Trade Commission and the Consumer Financial Protection Bureau on even higher alert in the advertising UDAP space. And so we want to encourage everybody who has consumer-facing products and services to, number one, advertise them completely and accurately. If you're getting paid by somebody, make that clear in your disclosure on the website. Number two, only advertise that which you're lawfully and actually able to do. I know that, we've spent a fair amount of time looking at a number of FTC actions here because, as you all probably know, the FTC has really seen a resurgence in activity in the financial services and consumer finance space since Andrew Smith became head of the Bureau of Consumer Protection. And I know we have a few other actions that we wanted to speak about today, one from early January and one from December. And Tiffany, if you can lead us through a couple of those, that would be fantastic.
Certainly, thanks, Allison. So in the Grant Teton Professionals case, it's, no pun intended, but it's actually kind of piggybacking on one of the cases Allison covered, in that it involved an alleged scheme in which the defendants claimed that they could improve consumers' credit card scores by removing all negative items and hard inquiries from their credit reports and adding seasoned trade lines to their credit history, so essentially credit piggybacking, which Allison eloquently described, which is obviously very problematic. And then defendants would, in exchange, but basically to support this credit piggybacking scheme, defendants would then solicit other consumers who had good lines of credit, who had very positive payment histories, to then add those consumers as authorized users. And in exchange for all these services, again, the upfront fees, advance fees are problematic. Defendants oftentimes charged upfront fees for their credit repair services. And also this included offering consumers opportunities to finance these fees without defendants actually providing the requisite credit transaction disclosures. And then oftentimes when defendants process these fees, they would charge consumers without obtaining proper authorization. And then to kind of top it off, when consumers complained about the lack of results or changes in their credit score, defendants then threatened legal action for consumers allegedly violating purported anti-disparagement and anti-chargeback clauses. And in most cases, consumers' credit scores were not improved. And this case was just settled in January of this year, and the parties entered a settlement that entailed a large monetary judgment, as well as injunctive relief in the form of defendants permanently being banned from operating or promoting any credit repair service. And then there are also very stringent record-keeping measures that defendants have to maintain for at least the next 10 years to demonstrate that they're remaining in compliance with the settlement. And then kind of onwards to the next case, the Consumer Defense LLC case. This is actually kind of in the home market. In this situation, defendants allegedly lured financially distressed homeowners into signing contracts for their mortgage assistant relief services by promising that they will receive expert legal advice or assistance by defendants to prevent them from going into foreclosure and help them modify their mortgage loans to make their payments more affordable. And so, again, this kind of goes to one of the points that Allison made. In this situation, defendants touted apparently a 98 to 100% success rate for obtaining mortgage loan modifications, and in most cases guaranteed that they could obtain that modification. And they also claimed that they had very special relationships with certain lenders, and that they could obtain reductions in homeowners' interest rates and monthly payments by as much as 50%. And oftentimes what happened was that the defendants would instruct consumers to not engage in any communication with their lenders, to not make payments, towards their mortgage, and would encourage consumers to forward all correspondence from their lenders to the defendants to essentially cut off all lines of communication. And as our audience or anyone listening could imagine, what happened was that a lot of consumers entered into a foreclosure as a result of it, or the interest rates increased substantially. And what happened was that defendants typically charge about close to $4,000 in monthly installments of $650, and also specifically told consumers that they would not start working on their file until they received payment. Again, upfront fees is a very common theme with a lot of these cases. And so in December of last year, the court ruled in favor of the FTC and found defendants' practices violated the FTC Act and the Mortgage Assistant Relief Services Rule. Again, another large monetary settlement of about $18.5 million. The proceeds from defendants selling their assets were turned over to the FTC, and those proceeds would be used to provide redress to affected consumers. And apparently, and I actually found this slightly interesting and maybe slightly entertaining as well, those assets include a Mercedes-Benz, an office building, and a Porsche Carrera, or Porsche Carrera rather, which I never had the pleasure of driving any of those things, but one can dream. And so there's also injunctive relief as well that was imposed, in which the defendants were permanently banned from debt relief business and also misleading customers with any other financial services that they offer. And we're just going to move forward. And I believe my colleague Jerry will continue discussing different FTC litigation actions.
Thank you, Tiffany. So moving away from some of the smaller company cases the FTC has brought, these next two cases, Fleet Corp and Lending Club, are the complete opposite of that. Fleet Corp, the last time I checked, had over $2 billion in revenue annually. Lending Club had somewhere between $1 and $2 billion in revenue annually, or half a billion and $1 billion annually in revenue, and both are publicly traded companies. What's really interesting about Fleet Corp is this is a business-to-business case. Fleet Corp provided prepaid cards or pay cards related to gas to commercial businesses or smaller businesses. And what the FTC is alleging is that there was a claim that customers could save money, and there was not substantiation for that. Or and the substantiation that the company had showed internally that it was way less than what they were telling customers they could save. The company was allegedly telling customers that they would be protected from unauthorized charges, meaning you as a small business can designate this card for your commercial drivers to only use it at the fuel pumps, and that turned out allegedly not to be the case. Of course, this is ongoing litigation. And one of the key factors that sort of permeates both of these cases is related to fees. Fleet Corp said there are no setup or transaction or membership fees, and the FTC is alleging that yes, there were, to the tunes of hundreds of millions of dollars. And so this case is going on through litigation, and it should be pretty interesting. And again, I raised the point that it is a business-to-business case because at one point I had heard someone a long time ago say, oh, the FTC never brings business-to-business cases, but they definitely do, and here's a prime example of it. The next case is the Lending Club case, and again, both of these cases, the principles that I take away are make sure when you advertise or market, you say what you mean and mean what you say, and that to the extent you make any type of savings or earnings or profitability claims that you have substantial substantiation for that. The Lending Club case is something that people in the financial services space, at least in the regulatory space, it's an issue that is very common to all of us. It's the intersection of TILA and UDAP. TILA is obviously a disclosure law that requires certain mandatory disclosures when you're lending, and UDAP is sort of a more amorphous, subjective catch-all, in my opinion, that goes beyond the scopes and is coextensive with TILA and used as it relates to advertising or any type of financial services. In this case, the FTC is basically saying, notwithstanding your TILA disclosures, which, by the way, we don't think were perfect, but notwithstanding your TILA disclosures, we still think there's a UDAP violation to Lending Club. And what the FTC is saying is, you very prominently, Lending Club, advertised no fees, no upfront fees. But in actuality, what you're charging is an upfront fee, and it's about 5%. And what the FTC has cited in their complaint are a number of things, one of which is that when you just walk through the flow, the user experience, what you see is the only place this origination fee is disclosed is when you click on a particular tooltip. And it's optional to click on that. It's not mandatory. Nonetheless, if you don't click on that, the only other time you receive notification about a origination fee is in the TILA disclosure, but it's down after sort of the first page on a phone, or you'd have to scroll down and it's not bolded and it's in between some other information. And so this is not an abnormal case. And the argument that we are in compliance with TILA, there cannot be a UDAP is an argument that has been made, and I would have to say not all that successful of an argument. And so that brings me to the sort of points of the case, which are to make sure that when you say there are no upfront fees, that there really are not, and internally that you're documenting and you're both responsive to internal in-house counsel, investors counsel, and that you're responsive to consumer complaints. The FTC went to great lengths in its complaint to cite and describe investors in the company who had noted that the origination fee that was being charged for Lending Club could raise a potential UDAP. There were customer complaints, numerous customer complaints that said, hey, I applied for a loan for $10,000. You told me $10,000 was on the way, and I got $9,000. The FTC, routinely uses, and so does the CFPB and state regulators, routinely use consumer complaints to show that a company is on actual knowledge about some type of practice. And so we always recommend that companies document and track customer complaints and respond to them and report that all the way up to senior management. Separately, the FTC added a Gramm-Leach-Bliley privacy issue, basically saying that before giving personally identifiable information, consumers did not have to acknowledge the privacy policy. And again, this sort of dovetails in with the tooltip disclosure. Both of these were not required to be acknowledged by the customers. And I do know that most businesses want the user experience to be seamless and painless, for lack of a better way to put it, with as less amount of friction as possible, with the least amount of friction as possible. But to avoid regulatory scrutiny, one of the things that is recommended is to make sure that your privacy policies have to be acknowledged in some way by the customers, and that they're available relatively easy in a straightforward manner. And of course, the last claim for Lending Club, because the FTC really wanted to pile it on, for lack of a better way to put it, was that there were unauthorized withdrawals from customers' accounts to repay the loans. And the FTC didn't stop there, which leads me to believe that this, and I think it's pretty clear that this was a case brought after a long investigation where apparently settlement did not work or come to fruition. But the FTC decided to note that Lending Club's rate of unauthorized withdrawals is comparable to loan servicers that have 3 to 4 times their volume. And then, of course, the FTC most recently amended the complaint to add in some additional information about consumer harm. So it will be interesting to see how these cases go. And I do want to note that all of these are allegations by the FTC. They will still have to prove their case in court in front of a judge. And so, none of this is certain of how it will come out. But the question and the points that I try to take away from ongoing litigation is, how can we as attorneys help our clients avoid being put into this situation at all? And having strong compliance and periodically looking back to make sure that your advertising and your business process and your user experience and the terms and conditions all match up is something that can really come into benefit. And I think this wraps up our touch points on the CFPB and the FTC. And so I'm going to turn it over to Allison to talk a little bit about the Prudential bank regulators and what we're seeing there in terms of enforcement activity, because we all know that when it comes to guidance, every federal regulator right now in the financial services space or general business space is putting out guidance as it relates to the CARES Act, PPP funds, or the pandemic. Oh, and I have just been reminded that I'm at the 2/3 point of our presentation, and I should tell everyone that the CLE code is FTC 2020, Federal Trade Commission 2020, FTC 2020. Thank you.
Thanks, Jerry. So I wanted to speak a bit about both what we're seeing from the Prudential regulators during this pandemic, but also specifically about a couple of enforcement actions, or really one enforcement action that I think has captured a lot of headlines, and it's the Office of the Comptroller of Currency, OCC's action against former Wells Fargo executives. This is kind of a unique action for a number of reasons. One, it comes out of the allegations around Wells Fargo's opening of accounts without consumer consent and the substantial fees that were incurred unfairly to consumers several years ago. The OCC, of course, is the National Bank Act, enforces the National Bank Act, and is the National Association regulator. So Wells is regulated by the CFPB. It's regulated by the OCC, and so the OCC, in addition to fining and sending a message to Wells Fargo, the company, it also took the extra step of pursuing litigation against its former executives. What's interesting here is that it appears that this is headed for trial. It looks like, as I understand it, the trial is scheduled to happen later this year. It involves, 5 former senior executives, including the former general counsel. There's a lot of money on the line. There's a lot of clawback money that would be required to be returned if the OCC prevails in its case. And I think it's a marked departure from the OCC's traditional approach of not being a particularly litigious or enforcement-focused agency. Usually, to the extent the OCC imposes strictures on its regulated banks, it does so through very quiet but nevertheless important and aggressive memoranda of understanding undertaken through supervision. It does do enforcement actions. Few are as headline catching as the former Wells Fargo one, and even fewer are as headline catching as this. And I note this because I think it's an important message that even in a world where it seems like the federal regulators have maybe stepped down a little bit from their enforcement-focused agenda under the last administration, it's still the case that the OCC, the FDIC, the Federal Reserve are focusing very carefully on what their regulated banks are doing vis-a-vis consumers, as Wells is doing here with taking these cases to trial. And they're currently scheduled to go to trial in South Dakota through the OCC's administrative forum. In addition, we are continuing to see a lot of output from the different agencies around guidelines about how lenders should be treating borrowers. We've seen additional guidance more recently about some of the provisions that lenders need to be taking into account as borrowers become unable to make loan payments during the pandemic, encouraging banks to find ways to accommodate their borrowers, and encouraging banks to really be thoughtful and prudent in how they respond to the crisis. And a lot of that guidance has been issued in what's called interagency guidance. So it's kind of joint agency guidance from the OCC, the Federal Reserve Board, the NCUA, the National Credit Union Administration, as well as the CFPB and the FDIC. And it's important to note that these agencies are paying careful attention. There's been a lot of conversation in the last few days about how banks have handled the PPP, the Paycheck Protection Program, which is, of course, the CARES Act's marquee program for getting money to small businesses. the frontline lenders are banks, and many of them are particularly large banks regulated by the OCC, and there's been a lot of scrutiny, at least in the media, around how those banks have responded. You can be sure that that scrutiny will continue probably at the regulatory level as well, as people want to just make sure that the money is getting distributed really on a first-come, first-served basis, as opposed to what some of the allegations in the press have said recently. Query as to whether they're accurate or not, but that's the kind of what we're hearing right now. And so I do think you're going to see a heightened interest in this. You're going to see banks looking very carefully at the way consumers are treated during this pandemic. The OCC's willingness to take this Wells Fargo case, executive case, to trial, I think is a signal that that agency might be willing to take other enforcement actions and go all the way with them, as opposed to historically settling and or relegating them to supervision. So I definitely think this is something we're going to continue to watch and pay careful attention to. I know that some of the things that we're looking at and really thinking about in a kind of a more holistic way go to the impact that the coronavirus is having on enforcement in general. And I know that Tiffany and Aaron have been following this quite carefully in their work, and so I'm hoping that they can walk us through some of the kind of more high-level trends that we've seen come out of some of these banking and regulatory agencies, as well as state AG offices in the last, call it, 5 or 6 weeks. So Aaron, if you want to walk us through that with Tiffany, that would be great.
Sure, happy to do so. Thanks, Allison. So I think first, just speaking more generally about what agencies and state AGs and federal agencies are doing, they're certainly not stopping, as we've already mentioned. They're continuing to issue CIDs and subpoenas to the extent that litigation is already underway. It is continuing. The same, social distancing and remote working that may be affecting other cases will still impact these cases, including video depositions. Some courts are holding conferences over video or Zoom. But I think that will continue, to the extent that it can. It is continuing. But where we may see more of a shift is in new cases that are and new focuses of agencies, including on consumers or individuals who may be more vulnerable because of the pandemic. Targets, cases that look like healthcare workers are being targeted, the elderly, service members, in general, people who may be considered to be even more vulnerable based on what's currently going on. And I think that Tiffany's going to talk a little bit more about how advertising practices has specifically been addressed during the last few weeks and kind of in the coming months.
Right, and so to Aaron's point, the kind of the whole theme of the impact of the COVID-19 on the legal environment, but just the environment in general, is that a lot of these agencies are primarily focused on protecting the most vulnerable populations, which Aaron already listed. And this isn't just limited to the financial services space. While that's the focus of this entire presentation, several other regulatory agencies are also issuing their own separate warning letters, including the FDA. And as you see from our presentation, both the FTC and FDA issued joint warning letters to several companies that had reportedly sold unapproved products that deceptively claim that they can treat coronavirus. These products can range from teas, essential oils, colloidal silver, and as most people probably know, or maybe you don't know, to date, the FDA has not approved any vaccines, drugs, or investigational products to treat or cure COVID-19. And again, like all these agencies are monitoring the marketplace and consumer complaints for allegations of false advertising related to the COVID-19 crisis. In state attorney general's offices, we've noticed as well that they've issued their own warning letters as well to companies for similar violations. This all bolsters the point that agencies are not turning a blind eye to legal activity during a pandemic. If anything, there's a heightened awareness or heightened scrutiny of allegedly unlawful company practices. And in terms of payment processing during the pandemic, independent sales organizations, payment processors, acquiring banks, need to exercise extra precaution in getting involved with online merchants that market these types of products and services. Of course, one of the best ways to avoid getting involved with unlawful advertising or selling a COVID-19 related products or services is just to remain abreast with the FDA's website, the Small Business Administration's website as it relates to the CARES Act. And again, as I mentioned earlier in the presentation, we have a very robust COVID-19 related task force at this firm that can handle a wide range of issues, including CARES Act related questions and just the parameters of that act as well. And we've already helped several clients on these types of issues. But we also do have a very strong FDA practice as well that can advise clients on, just things to be aware of where the FDA or some of these other agencies are in terms of approving certain products. Again, while these agencies have a heightened awareness of the scams and unlawful products that are being offered, it's important for our audience and to be aware of these things as well. And so just kind of transitioning to best practices for navigating 2020, Allison and Jerry are going to touch on those topics to kind of conclude our presentation.
Thank you. Jerry, if you want to start and I'll add on.
Sure. Sounds great. So some of the best practices we recommend, obviously recognize and adjust accordingly to the COVID-19 pandemic and its impact on everyone and everywhere for that matter. Monitor the regulatory updates and make changes as required. Just a few examples that we pulled out were, the prepaid card and compulsory use as it relates to Regulation E. The CFPB has made certain exceptions. Almost every regulator of a mortgage servicing company and origination company has issued some kind of guidance relating to loss mitigation, forbearance, or appraisals, and when and how those can be conducted or how closings can be conducted. Student loans is obviously another area where even before the crisis, there was a significant amount of borrowers going into income-based repayment or other types of repayment plans. And so now the CARES Act has provided a window where student loans can be entirely stopped and the interest can be stopped as well. So that is, keeping up to date with regulatory changes is very important. And second, review all of your advertising to the extent you make any changes for the COVID-19 pandemic. And of course, I said this earlier, but to the extent you change anything, you should always go back to your terms and conditions or your terms of service and make sure those match with whatever your business flow change has been. One option that businesses may want to consider would be some type of temporary COVID-19 clause being inserted into the terms and conditions or terms and services, referencing back to an easier page to change or update or something along those lines. And again, regardless of the current pandemic, it's always a good practice to make sure that what you are offering your customers or what you are advertising or marketing is what they are getting. And that, just by way of example, that, your terms and conditions don't state something that you haven't been doing for 5 years or that you never intend on doing. I know in the past there had been a lot of legal recommendations to put a sort of, we may do this into a terms and conditions, and then you never do that. What we've started to see is that plaintiffs' attorneys have started to take advantage of some of those gaps and said, well, if you were never going to do it, then why is it in here? Clearly you intend to do it or you wouldn't put it in here. And trying to allege that there's likely to be some type of harm in the future, where, of course, that may not be the case. And to the extent you use any type of online advertising related to whether that's lead generation or your own marketing or using affiliate marketing practices, you really want to keep tabs on what is being said under sort of your brand or your name, and making sure that that is always correct. There are a variety of ways to monitor all of that. And additionally, what you do want to do is make sure that any affiliate marketing or online leads are only ones that are approved by you can actually connect to your payment mechanisms. So there are ways to stop bad affiliates or bad marketers from trying to take advantage of your brand. And of course, we could walk anyone through that. Allison, why don't I turn it back for the last few points and closing it out?
Yeah, thank you, Jerry. Thanks everybody for joining us today. In short, I kind of just want to make sure that we reiterate that during this pandemic, it's really mission critical to remember that the regulators and the enforcement offices and those regulatory agencies are going to be looking very closely at how companies with consumer-facing financial services and products offer those products and services to consumers, how they treat consumers. Do they err on the side of being pro-consumer? And I want to stress that point. There's a lot of guidance that's coming out of state AG offices, state regulatory agencies, some of the federal agencies, as well as the CARES Act itself. And some of that guidance is clear, and some of that guidance actually leaves open some lack of clarity. You should always err on the side of the consumer, especially right now. That's really our mission-critical advice to everybody. Thank you so much for joining us. Please stay safe and healthy, and we appreciate the opportunity to apprise you of this financial services advertising update in 2020. Thank you so much.